welcome to the second episode on corporate governance provisions in the Companies Act 2013. To discuss these provisions, we have with us Mr. Siddharth Birla, Senior Vice President FICCI and President-elect, and Mr. Bharat Vaklu, Resident Director at Tata Sons Limited. Should we begin this discussion by going over provisions which deal with vigilance over companies in the Act? What does the Act do, particularly for listed companies? What does the Act do for this subject?
Soma, I think one of the key things about this new Companies Act is the fact that there's a greater push towards transparency in the functioning of the company's processes, in ensuring that minority shareholders as also shareholders and stakeholders in general get a better perspective of how the company is being run. Now, very often you might have companies which traditionally may have not been very open about the way things happen. And if you have somebody in the organization who can report freely to the audit committee of the board on matters which in that person's perception violate the provisions of the Act or are against the spirit of this new openness that's required and a new accountability that's required,
or even proprietary issues,
then that person under sections 177, 9 and 10 would be A, given a chance to report to the audit committee of the board, and B, the company would have to ensure, as per the Act, sufficient safeguards to prevent that this person is not either oppressed in some way or pushed out of the business or victimized, or somebody doesn't become vengeful. So I think this is a very good provision, and you would have seen that this is quite frankly aligned with what's happening worldwide in terms of encouraging more transparency. So I think sections 177, 9 and 10 are really a new addition and a good addition. But we need to now encourage companies to take this in the right spirit and not only look at this as a mechanistic thing to be done, have an audit committee say we will also take inputs from the whistleblower or the so-called vigilantes or whatever you want to call them, informers, but to actually encourage openness. And this openness has to be all pervading across the board in the company, and specifically where we feel that the board's actions and the board's governance has in some way violated what is appropriate.
Right. So you feel these two provisions lay the foundation for a whistleblower mechanism in the law for the corporate sector?
Yes, I think they do. And I also believe it encourages companies generally to behave more ethically, to behave more transparently, and to behave with accountability. And accountability to not just the government or the upholder of the Companies Act, but accountability to stakeholders, accountability to employees, to vendors, to bankers, to investors. So that whole ecosystem, in my opinion, will be strengthened if you have a vigilance policy or vigil mechanism, as the Act mentions it, and encourages people across the organization to have the openness and the courage to report to an audit committee of the board, which would hopefully take cognizance and not let it lie. You see, I think that's the other important point. The audit committee of the board has got to take conscious cognizance of what comes in, and if there is evidence that supports the complaint, it will have to take action. And that may not be so loosely mentioned in the Act, but that is an understanding which the board will have to encourage.
Any reasonable man would just have to draw
and not say that, look, this is just a false complaint and pretend it's dead and gone. I think the spirit really is that the board will take appropriate action based on this, even if it is a fictitious, it's a figment of the person's imagination and does not need action. Even that should be recorded and told to all concerned. And there's also mention here that all this information will figure on the company's website, and that's a very, very good thing, because stakeholders, shareholders, investors would know that, look, this is what had happened, this is how the board addressed it, and this is how it has been brought to closure. I think these are good steps.
So this would get published after the issue has been dealt with?
No, even when the whistleblower or the vigilance informer has raised a point, it has got to figure on the company's website, even as the audit committee takes cognizance of it.
Right. And the informant has to identify himself? And he is subject to protections.
I think so, yes. The
Right.
protection part is important.
Because he's identifiable.
Exactly. I think that is a key point.
Right.
But even if the company does not encourage a person to reveal his or her name,
Right.
I think even otherwise, given the way the grapevine works and so on, protection is critical.
Right.
Such a person should not feel that I am now being victimized simply because I have the courage or I stuck my neck out to do something which is in the larger interest of the company,
Right.
its investors and shareholders, but which put that person into relative jeopardy.
Right.
If I can actually
Supplement.
and take something from what Bharat said, I think many of the provisions of the Act, such as this whistleblower, and there'll be many other introductions in the Act which have happened probably for the first time in law. I think the common thread which binds them, if you really go to the duties of a director or the duties of a board, and what has happened, you'll find that earlier, really speaking, the responsibility of the board was primarily towards the shareholder. And therefore, the need to act towards a wider jurisdiction, which is stakeholders, employees, environment, etc., was all implied.
Right.
This time it's more explicit in law. And it's very interesting because there's been a debate as to whether it should be made explicit or it should be left implicit. And I think the balanced view is that the implied was always there.
Right.
You could not run a company without the interest of the employees, without the interest of the stakeholders. But on record, you would be running the company for the benefit of the shareholders.
So would you say that we moved from an era of shareholder activism to a potential era of stakeholder activism in the life of a corporate?
I would not call it activism. I think, as I said very simply, what was implied in the law has now been made explicit. And I think, so people are reading that explicit to mean something new. But I think
it was always
all this, for example, the whistleblower, the vigil mechanism, and there are some other provisions, which all go ultimately towards addressing a larger, what informally we call a stakeholder universe, which includes shareholders and one very important part of the stakeholder universe.
Right. So let's take examples so that it becomes clearer. A company is in financial difficulty. It owes monies to lenders. And an unstated policy starts where the assets of the company get ferreted out. An employee sees this, thinks it's improper, uses 177(9) and 10, calls up and says, this is happening, this is wrong. Enter the board, it has to deal with this because it owes a duty to stakeholders, not just shareholders. And therefore, if even an unstated policy of harming lender interests is in implementation, the board needs to pull up the management and get involved. Would that be a fair illustration of how this would work?
I think so. I think it really shows the myriad opportunities that exist for the board to act and prevent wrongdoing. But I liked what Siddharthji said about the explicit mention of the role of a director. Under sections 166 subsection 2, it very clearly states that the director will act to uphold the provisions of the Act, obviously, but also take care of country, stakeholder, community, and the larger ecosystem within which companies operate.
Right.
So I think, there is a greater responsibility, a societal responsibility. Somehow, I might even think if you were to treat the environment also as a stakeholder, even an environmental responsibility which emanates from this. And that, in fact, probably is the reason why this Act also contains a section under 135, which talks about corporate social responsibility. Because I think the underlying impact of this Act is it is broadening the way you look at enterprise and business. Typically, when you would look at a factory, you'd say, oh, my boundary wall is this, and whatever I do inside it is my jurisdiction. No longer that. You're getting resources from outside. You're spewing out effluents, hopefully treated. You're dealing with communities. You're dealing with employees. You're dealing with vendors, bankers, lenders, regulators, and the whole...
Who in turn have their public interest to...
Exactly. So I think that's really the point that was being made.
alluded to CSR. Should we talk a little bit about CSR and where does that fit into the governance system?
I think, fact is this is definitely a piece of legislation with all these sections and including the section 135 on CSR, which is, to my mind, it at least addresses concerns that people have had about the functioning of businesses. And in that sense, it's a forward-looking, progressive act, which I think for the time of which had come. Now, what section 135 says is that a company which will have a turnover of 1,000 crores or more, which has a net worth of 500 crores or more, and which has profits, average profits over 3 years exceeding 5 crores or more rupees, would have to create a subcommittee of the board called the CSR subcommittee, comprising of 3 people or more with an independent director. And this subcommittee of the board would lay down what the Act calls a policy, but which in reality is a program of expenditure related to community action, related to health, livelihoods, ecology, environment, and so on, wherein some funds, and in this case 2% of the average profit before tax, would be earmarked for doing all this. And there's a reporting mechanism which is also specified under the Companies Act. Now, what it really does is it augments in the local area around a company's operations, it reinforces the involvement of the company in community development, and this can only be possible when there is stakeholder engagement, which means community engagement. There is a greater communication between the company and the people who live around it. Only then can the company do all this. So I think it's a good way to give a
supplement the stakeholder policy.
Exactly, and to also give a leverage to what the government wants business to do, which means be a part of the inclusive development agenda of the country.
I think, let me start on a lighter note. Very often from FICCI, we've had to remind people that this is the Companies Act and not a CSR Act, because every time we start discussing the Act, people just launch into CSR and they stop there. I think I'd like to supplement what Bharatji said. The CSR concept is an evolving concept, and I think it is a recognition on part of the government to encourage companies to do what they feel is right, rather than just look at a government or wait for a government program to happen. Perhaps the efficiency of the money spent on the ground also would be higher. So therefore, it is an encouraging, it is an enabling framework. At this moment, I would actually stop at calling it an enabling framework. What the law has done is said, it is mandatory for you to have a committee. It is mandatory for you to consider what CSR you will do. It is mandatory for you to report to your shareholders and to the world at large. What is your decision? Your decision could be well to spend 0, because I might have made 100 crores of profit, but I have 120 crores of debt service on my balance sheet. So the board of directors may, for very good reason, may decide that I can't do a CSR. Secondly, there is a lot of confusion over this appendix which is attached to the Act. Now, I read the appendix very differently from the way people talk about it.
The appendix that lists
the one which lists the activities. The Schedule 7
of this Act.
They feel that this is what the government wants you to do as CSR. And I read it very differently. The government actually, it is simply 7 items or 10 items which have been benchmarked and left in the broadest of terms. For example,
but they're not exhaustive by any means.
They're not exhaustive by any means. For example, when you talk about infant mortality, when you talk about women empowerment, there may be 100 things you can do under them. And you don't have to stick to that list. You may find something else is relevant for your company. So I think the intent of the law, as well as the way it's written, is to allow the highest flexibility to the companies in choosing what they want to do, in choosing how much they want to spend, in choosing how they want to do it. I think the key point is that the board has to be accountable.
So the buck stops with the board, really.
The buck stops with the board.
It's a framework, it's a platform, but the board
is an enabling framework.
Consciously decide what to do, how much to do, if to do, but all well reasoned.
Could I just add to what was mentioned? This is the part that the Act talks about under Section 135 is really the post-profit activity of the company with respect to community development. So Soma, I was just keen to add to what Siddharthji mentioned. You know, a tacit point in the Companies Act, which is not stated anywhere, but which is really part of the spirit of the new act, is the fact that I think the expectation is that companies will really even make their money in a way that is holistic, wholesome, beneficial for all, including the environment, including communities that are impacted by what the company does. And its actions do not create a world which is, let's say, at a disadvantage compared to the way it was to start with. So we have to read Section 135 keeping this point in mind.
Supplementing that
exactly.
principle. And what is legitimate has been redefined to a wider world.
Exactly. And we have to therefore appreciate that while Section 135 figures in the Act and therefore in some ways is a quasi legal provision which is more or less mandated, at the same time the underlying expectations of the boards will be to take into account that you ensure environmental sustainability, social justice, community well-being, and the improvement in the quality of life of all stakeholders without exception.
Sure.
I think one very important signal in the bill is the level and the involvement which at least the government expects from the corporate sector. Because if you look at the threshold, 1,000 crores or 500 crores, and then you suddenly drop down to this figure of 5 crores of net profit, one could argue that many large shops and restaurants make 5 crores today. I mean, not just corporate. But I think the signal, therefore, is that the 1,000 and 500 are just
those
there.
who impact the rest of society.
The people who, so it's the guys who earn 5 crores. So even theoretically, even if you were to spend 10 lakh rupees, which is 2% of 5 crores, that's a signal I think that the bill is giving.
Sure. Sure. Let's move to another area relating to governance, which is of remuneration, managerial remuneration, what you pay the executive, what you pay the non-executive, what is the philosophy, what is the law, and any perspectives you have on how the Companies Act 2013 regulates this subject.
I think in technical terms, first of all, if you look at the overall framework, the old framework was that when you have a managing director, you can pay one whole-time director 5%. If you have two, then you can, all of them together, you can pay 10%. You can pay another 1% of profits to the remaining directors. So the cap, the overall cap, was 11% of profits could be distributed between operating and non-operating directors. That remains the same. Number two, there was a table laid out which earlier was Schedule 13, which specifies that what is the minimum remuneration you can pay if you do not have sufficient profits. Sufficient profits doesn't mean you're a loss maker, but sufficient profits means you don't have the 10% or the 5% to pay the people. I think some limits have been relaxed, and I think there are some additional provisions that with a special resolution you can in fact double the amount that you pay as a minimum remuneration. Having said that, these are the specifics. There has been a lot of pros and cons and arguments since the time the bill was under evolvement, not just the Act. Whether managerial remuneration at all should be subject to any limits or not limits. Let the shareholder decide what is to be paid to the management, etc. I think since the earlier times when one view was that it should be completely freed up, we also saw the rest of the world come hard down on managerial remuneration. And before it became an issue, and it probably has become an issue in some of the foreign very large corporations.
There's a lot of debate on
there is a lot of debate. There is on CEO pay.
Evidence is divided about whether the state interferes or shareholders determine.
Exactly. But so I think one has to strike a balance at some point of time. So now let's read the new law, and there are some other side issues on the law as far as remuneration is concerned, that now a board has to show how much its top management gets compared to the median salary in a company, and therefore what is the sort of spread over which a company is paying money. I think those are more social indicators to show that whether you're being responsive. There was, of course, the need of a remuneration committee where the management was absent. It was completely non-executive directors must form the remuneration committee, with a majority being the independent directors. And therefore, independent directors have a larger say or have the key say in the determining managerial remuneration. So I think these were issues which were covered under SEBI, which was only for listed companies, but now it has been brought into the law.
Right.
And we have a remuneration committee requirement for most companies which would have high remunerations. So I think a balance has been struck. This is to my mind, a balance has been struck as because even though we have some companies where very high levels of rupees are paid in India, but that is what was permissible under the 1956 Companies Act.
Right.
So I don't see that India has today in a stage that we require to double those limits or triple those limits and leave it completely free. So I mean, I think it was a balanced decision, and it is probably in line with what the rest of the world is also doing.
Right. Is there any gearing or differentiation between public or listed companies and private companies and small companies? And
I think two issues. One is that this law applies to everybody uniformly. And secondly, the threshold, the method of calculation has been kept the same as the earlier Schedule 13, which is depending on the size of capital employed by the company. Okay. This is what is automatic. It does not mean to say you cannot pay higher than this. It simply says this is what you can pay without approaching the government for approval.
Right.
If we think that we can make out a case to pay X person such and such amount, which is beyond those limits, one is free to approach the government for their approval.
Right.
And I think what the ministry is encouraging is that please come to us for approval before you actually pay the salary, rather than just pass a resolution, start paying him the salary, and then come for a post facto approval.
Right.
So that is probably implied.
Okay. Okay, let's move to another area relating to governance, but also relating to a larger market protection, the subject of insider trading. We are one of the unique countries where both under regulations and now under the Companies Act, where at least the concept is defined. Whereas even in the United States, there is no definition except for a fair dealing standard in very fuzzy generic terms, which leads to a lot of ambiguity on when is an act by a person illegal. So what is the law on insider trading in the Companies Act, and how do you see it impacting governance in a company?
Let me start off by saying that the Companies Act has brought insider trading within the ambit of the responsibilities of the board to ensure that nobody in the company, no key managerial personnel, no manager, no director or whatever, is able to use information that he or she is privy to make what you might call a killing or a windfall gain from the sale of the company's stocks.
Right, sale or purchase.
Sale or purchase.
Before the market gets.
Exactly.
Right.
Essentially, what we're saying is, in order to protect the interests of all shareholders uniformly, any information that is available with the directors cannot be leveraged for their personal gain.
Right.
So in a nutshell, this is what the
principle
is. Now, in my view, whatever information therefore is material to the company's perceived value has got to be shared as quickly and as effectively as possible with all shareholders, which is why SEBI encourages that the listed company should give out information through the websites and through SEBI's, and the stock exchanges have to be kept in mind and so on. So I think it's again a trend towards more transparency.
Right.
And the point that Siddharth was making earlier about remuneration also, there also the companies are encouraged to share with the general body what it is that is being paid to key managerial personnel, to the directors, to the whole-time directors, to the full-time directors, so that the general body can say, yeah, we agree that this is, you have all worked very hard, you all given the goals that, delivered on the goals that had been committed last time or last year, You have taken risks, you have secured our investments, and we are happy to give you this remuneration. So, enlightened self-regulation is really at the heart of this new act. And whereas, I mean, I'm not an expert on insider trading per se, but I do see that across the act, you will see the same spirit underlying the provision. And I think that, to my mind, is very reassuring. Because now, the onus is not on government. You know, typically, Siddharth, you remember barely 5 or 10 years ago, companies would say, oh, we got to go to the government for everything. No longer. Or at least for a large measure, the compliance is within the hands of the company and its shareholders. And there is also provision in the Act now for minority shareholder representation on the board. And that also will ensure that, you know, all the various aspects, all those who are impacted by the business are reassured that the company is not doing anything adverse to their interests. And that's really where the insider trading part fits in.
So philosophically,
exactly,
as management, you make your money through the remuneration provisions, not by possession of unpublished price-sensitive information.
If I can quickly add, I think, of course, the minority representation is, I think, as optional as it was in the old Act, and therefore it is an option with the company. But more than that, I think the insider trading is again one element of what goes back to the fiduciary responsibility of the directors. So the directors owe a fiduciary responsibility to the owners of a company. The shareholders, which is all shareholders, it's not just one set of shareholders, and therefore to try and see that there is no misuse of information which is not in the public domain is the key issue. The second thing is sometimes we can argue about, you know, whether we've written too much in the law or too little in the law. I think the fundamental is that we have to catch up with many of the advanced countries where this law is very much in vogue. The principle of insider trading. And number two, that the courts in those countries have far more advanced standards which can be applied. So I think when we are catching up, we sort of bring in all the collective knowledge, and because our courts because the court is the only place where these things can be tested, and then our courts would need that kind of basis to proceed if there is a violation.
And I must mention that the specialized regulator, SEBI, is in parallel writing new regulations for insider trading. So, and SEBI is authorized empowered under the Act to implement those provisions even under the Companies Act. So it's all going to lead towards a more robust, clear regime.
We have, of course, been always suggesting that, because SEBI was the first one which really brought in the corporate governance requirements under listing agreements, as to how much we could synchronize the provisions of the Act and of SEBI regulations, so that the corporates who are the ultimate, the users, there has to be clarity, because we cannot have multiple laws operating. And if there are differences in interpretation, they need to be synchronized, and I think they are working towards it, as you mentioned.
So before we wind up, is there any other aspect of governance that you would like to highlight?
Yes, I think I would like to mention that, you know, it's a wonderful thing that the Companies Act of 2013 is now a reality. The Companies Act of 56 was current for over 57, 58 years. And if you look at what has happened in our own country from 1956 to now, you will agree that none of the people who wrote the Companies Act in 56
could have thought about today's society.
I would therefore like to mention, for the benefit of all those who see this video, that the Companies Act 2013 again has to be seen from the perspective that it is, as of today, the lawmakers who made this law have looked ahead into the future and have said this is how it should work. But I think the greater responsibility lies with the boards of directors, lies with the investor community, the ones who invest into companies, to ensure that with time and not so not so far into the future, but in the next few years, I foresee changes in technology, in the way countries manage resources, the way the countries manage their affairs, that even some of the provisions of this act might become archaic or defunct or old. Does that mean that we have to start scramble around to make a new act? No. It just means that the boards have to be aware of this and not take recourse to an antiquated provision if the expectations of the investor community or shareholders or stakeholders demands a higher response. And that higher response is what we expect of the boards.
Yeah, and I must mention that legislation of this nature, unlike fiscal statute, the principle of law is they are to be interpreted with a purposive intent.
Exactly.
So you got to project what the intent was, and if two views are possible, you adopt the view which furthers the purpose.
Exactly. I think that is really my view on this matter.
I think in a nutshell, Bharatji has covered much of it. In a nutshell, I think the new Companies Act sets new standards for responsible behavior. That's the way I would describe it, whether from boards, whether from investors, whether from all stakeholder communities, and brings it together. So I think we should look for an era of enhanced responsibility as well as responsible behavior.
Thank you. This has been a lively discussion. There is no capacity for any law to be completely future-proof, but the Companies Act 2013 does lay out principles of governance which we have discussed in this episode. This video is intended to only give a broad overview and give you pointers on specific issues to look up. Please do read up the provisions of the Act to acquaint yourselves better with the actual requirements and legal provisions. Thank you very much for the lively discussion.
Thank you.
Thank you.
Thank you.
Thanks.
Thank you.